about the other methods of arriving at an optimal capital structure. And we've already seen the first two, which is the minimizing of cost of capital and the minimizing of cost of capital plus maximizing the operating income approach. We are now going to focus our understanding on the adjusted present value approach, where the optimal debt ratio maximizes the overall value of the firm. And we're also going to look at the sector approach, where the optimal debt ratio is essentially the one which reaches closer to the sector averages. Right, so we will look at both of these one by one. Let's first look at the adjusted present value approach and understand what does this mean. Now, in the adjusted present value approach, the value of the firm is nothing but the sum of the value of the firm without debt and the effect of debt on firm value. Right, so there are two effects of debt on the firm value. In terms of benefits, the debt gives you a tax advantage, right? So it gives you a tax benefit. In terms of problems or the negative effects or disadvantages, there is a bankruptcy cost that comes in, right? So technically the value of the firm, let's say the firm has zero debt. So effectively unlevered firm value, which is assuming a firm has zero debt. And if the firm takes debt, then what comes because of the debt is the positive impact, which is the tax benefits of debt, and the negative impacts, which is the expected bankruptcy cost from debt, right? Now, so the negative impacts have to be subtracted, the positive have to be added. And if we can arrive at this, that's going to be the firm value. And the optimal debt level is the one that will maximize the firm value, correct? So the level at which the firm value gets maximized is what is going to be the optimal debt level. So that's the broad construct of how we work here. Obviously, we will need to find what is the unlevered firm value. What we get in the market is the levered firm value. We will need to identify what are the tax benefits of debt, and we will need to calculate the expected bankruptcy cost. Remember, bankruptcy cost is a function of both the direct costs and the indirect costs. So we have to look at both of these costs and try and arrive with a number, and that's what is going to be a little bit tricky part in terms of our discussion here, right? So let's understand, to solve this, the first thing we need is the unlevered value of the firm. Now you can either calculate it by valuing the firm using a cost of equity calculated with the unlevered beta, right? So that's one way. Or we can remove the tax benefits and make adjustments for bankruptcy cost to arrive at the unlevered values from the market value. So effectively, the current market value is nothing but it includes all the benefits of debt. So we remove the tax benefits, correct? And we add the bankruptcy costs. That's nothing but we are changing this earlier equation. So to get to this, we take the firm value from the market, we take tax benefits minus expected bankruptcy on the other side of the equation, correct? And so we get this equation where we get the current enterprise value, and from there we remove the tax benefits and bankruptcy cost. Then at every debt level, we need to calculate the value of the tax benefit that comes to us, correct? What kind of benefits are due because of the debt, and we need to calculate the expected bankruptcy cost. And not just the bankruptcy cost, there is also going to be a probability of bankruptcy. So the expected bankruptcy cost, remember the expected value is nothing but the probability into the outcome, right? So that's what we are going to get. We first need to find out what are the chances. Probability is nothing but the chances that a firm may go bankrupt. What are the chances that a firm may go bankrupt? So we need to first find out this probability, and that's a difficult task. So we will rely on estimates that have been given to us by other experts in the field. And then we have to look at what is the cost essentially at every level, right?